Well, the news just doesn't stop, does it?
It's the gift that keeps on giving the whole year.
Non-QM's going away. This is just like the alt-A implosion of 2008, 2009. No, it's not. It's completely different, and this doesn't just affect non-QM. It's all non-conforming. A lot of your jumbo business is being affected right now too, and today we're gonna go over why. You hear it from everyone. There's no liquidity. The liquidity in the marketplace is gone. What in the world does that mean? What does it actually mean? Liquidity, at its most simple, it's just money. Look, I got some right here. 26 monies. Do you have any idea how many cups o' noodle that's gonna buy me in the next month or two? There's plenty of money out there. The liquidity is not gone. It's all about the investors. The investors and what they want to invest in. The markets are crazy. Yes, you can blame coronavirus on this, but there are very specific reasons why, and not a lot of people are actually putting that out there. They're just saying the liquidity is gone and they're not giving any detailed explanations. That's not good enough. And today that changes. Now let's go over why this is different from 2008, 2009. Back then, our mortgage industry imploded because people were making bad loans. Those bad loans weren't performing. People weren't making their payments. Lots of foreclosures, lots of late pays, lots of everything. And this isn't happening again. Why? Because the loans that we're doing today are good. They're performing. Did you know that the nationwide default rate on conventional loans is 3%. 3% of all conventional loans has a default of some sort. Did you know that the nationwide default rate on non-QM loans is just 4%? 4%. These loans are performing. They're really good loans. Did you also know that 67% of statistics are made up on the spot? Not these though. The bottom line is that investors are not buying mortgage-backed securities. Not the non-conforming ones anyway. Plenty of agency mortgage-backed securities being bought and sold because agency-backed means government-backed. There's a lot of extra security there for an investor. For the non-conforming stuff, they're putting that on hold. People aren't buying it. People aren't investing in it because the world is nuts right now. The financial markets are crazy. Everything seems to be a roller coaster ride. Trust me, as the senior manager of the specialty products team at AFN, how do I feel? Like I'm gonna need those cup o' noodles. But I'm still here for you guys. I wanna stay here, I wanna stay strong, I wanna bring you the info, I wanna bring clarity. Not many people break things down very simply these days. And that's a terrible thing, because how the heck are we supposed to learn? Let's lean into our community, let's rely on each other, and let's get the good, pertinent information out there so we can educate the people that we need to educate, and so we can get people in the know. So let's say that Anakin and Padme find out that they have twins on the way, so they need to upgrade from their condo on Coruscant to a big, beautiful house on Naboo. When they're shopping for this house, they need a loan. So who do they go to? They go to a bank, and that bank lends them money so they can buy the house. Hooray, happy family. But this is only the start of the process for mortgage banking. This bank most likely didn't lend their own money. They got a line of credit. That line of credit is extended to them, could be a couple $1,000,000, could be a couple $100,000,000, depending on the size of this bank. They borrow money from that line of credit so they can then lend it to Anakin and Padme to buy their house. Then they pay back their line of credit. Usually they have about 30 to 45 days to do this. How do they pay back that line of credit? Well, this bank is not just making one loan, they're making multiple loans. And they take those multiple loans and put them into a pool. You got Anakin and Padme's loan, along with quite a few other loans. They take those pools of loans and they sell them to bigger banks. Big, large banking institutions buy these pools of loans. In the industry, we commonly refer to these banks as investors or aggregators. Now, these big banks also lend to people like Anakin and Padme, but a lot of their business comes from buying pools of loans from smaller mortgage banks. Once they buy this pool of loans, this bank gets their money back, they pay back their credit line, all is well in the world of this mortgage bank. Now, this larger bank has a big pool of loans, along with all the loans that they made to people like Anakin and Padme, and loans that they bought from other mortgage banks. They're buying lots of these pools and aggregating them into larger pools of loans called mortgage-backed securities. these mortgage-backed securities, once big enough, can be issued to the investor market, secondary market, on Wall Street, where all these lovely investors looking to invest their money into mortgage loans can purchase mortgage-backed securities. Once they purchase these mortgage-backed securities, this bank has their money back. This bank may have lent their own money, but they may not have. Sometimes they have lines of credit very similar to the smaller banks, only their lines of credit are a bit different. They're larger, they don't have 30 to 45 days to pay them back. They have 4, 6, 9, sometimes 12 months to pay them back. Depends on how it's negotiated, but these banks have a lot longer to pay back their lines of credit because it takes longer to get a mortgage-backed security issued. These investors purchase the mortgage-backed securities. These monies go back to the big banks. The big banks pay back their lines of credit or pay back their other investments, whatever they need to do. Everything is right in the world for everybody along the line. And Anakin and Padme are happily making the payment on their mortgage. So there you go. Mortgage Banking 101. That's kind of how it works. But how does coronavirus change all this? Well, we have a lot of stay-at-home orders. We have a lot of people who are out of work right now. We don't know exactly what's going to happen. Neither do they. They don't know what's going to happen either. Now, they still want to invest in mortgage-backed securities, but right now they're allocating all of their funds to agency mortgage-backed securities, not non-conforming mortgage-backed securities. So they're only buying MBSs that consist of conventional and government loans because they're government-backed. There's more security for them in that investment. The non-conforming MBSs, or the ones that are full of non-QM and non-conforming jumbo loans, lots more risk. Why is there lots more risk? Well, because this loan being made to Anakin and Padme assumes they're still going to be employed to pay for it. The line of credit is assuming that this bank has verified that employment, and by the time it gets sold to the big bank, everything's going to be okay. Because if everything's okay with their employment, then this bank gets their money, which pays them back. Same thing here. By the time it takes a few months to get an MBS issued, that all assumes that they're still going to be employed, making their house payment, and they're going to be able to pay everything back, which means this is a secure investment. But right now, there's a lot of questions about what people are and aren't going to be able to pay back because employment, it's a big issue right now. Those of us with jobs who are working and making silly videos on LinkedIn, we're the lucky ones. But these people know that. They don't want to take that extra risk. So if these people stop buying these, then these people can't issue these. And if these people can't issue these, then these people can't buy these. And if these can't be purchased from them, then you can be sure that these are going to seize up in both directions because they can't be sure they're going to get their money back. And if they seize up, they can't lend. If they can't lend, they can't borrow. And non-QM and jumbo goes to hell in a handbasket. So what do we do now? We take care of the borrower, just like we always have. There's a few companies still out there that are funding and purchasing non-QM loans. It's our responsibility to lean into them. If you're a retail originator and your company has recently stopped funding non-QM loans, find a way to rework those loans and broker them out to the companies that are, so we can still take care of our borrowers. Because remember, these are performing loans. They're good transactions. The default rates are low. They shouldn't go away. And once all this pandemic stuff is behind us, the liquidity, the money from those investors, it's going to come back into the market. And we will see a resurgence in this product space. Until then, let's hunker down and support those who deserve the support. I work very closely with a few companies who really need the support right now. Sprout Mortgage, Angel Oak Mortgage, First National Bank of America. I have firsthand experience with all three of these players. Send your loans to them. We need to support those who are still supporting the market. This is temporary. It's not going to last forever. All you people who are loving seeing non-QM go away, just wait a few months. It'll be back and you're gonna hate it just as much. But for now, let's put the complaints aside. Let's deal with our current pipelines. Let's come together, help each other, support each other. Sprout, Angel Oak, First National Bank of America, those are my preferred lenders. You have yours, let me know. Thanks a lot, guys, and we'll talk to you later.